It's finally here, the moment of truth for financial markets after a very busy July, a very busy August, speculating on Fed policy. We've gotten all of the stage setting out of the way. The Fed policy announcement comes on September the 18th. And now we face the first critical piece of economic data that is going to tell us whether the Fed is behind the curve on rate cuts and is going to give us a double-sized 50 basis point reduction, or half of a percent, or whether everything is okay and a 25 basis point or a quarter of a percent move is enough. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and we are going to unpack what we are looking to see from the jobs report for August. That is, of course, the data that I am talking about here. That's coming at us in less than 24 hours here. And what we are going to do is we're going to unpack what the expectations are, why this is relevant, what is it that this can do to inspire market action, and with that, to give us some kind of a lead on stock markets first and foremost, but of course, likewise on bonds, on commodities, on currencies. And so let's begin here with a look at the expectations. Markets are looking for the U.S. economy to add 160,000 non-farm jobs. That's a little bit of a pickup from the very disappointing 114 reading that we got in the prior month. That was, of course, a big catalyst for markets. August 2nd, that number came out, and all hell broke loose. Stocks continued to have a very wild ride all the way through the subsequent Monday, August 5th, and that was, of course, a major volatility spike across virtually all global markets. The expectation here that we'll come back a little bit from those indignities and end up with 160K, still somewhat in the middle of the recent range of outcomes here, but a little bit better than this reading here. The jobless rate seen coming in a little bit from 4.3 down to 4.2%. Now, at face value, these don't look like dramatically significant deviations from where we've been. The jobless rate has come up a little bit in recent months. Obviously, 4% with something of a guidepost here. That was the top of this digestion that was taken out here, and we got some readings above it. But none of this looks like the labor market is running away this way or that in a hurry. In fact, that wild sell-off that we got on the jobs data last month, that reading of 114 wasn't even so dramatic relative to 108 just a few months back before. So why is this so reactive suddenly? Well, the jobs data is usually looked at very closely because it speaks directly to one half of the Fed's policy mandate. The Fed is tasked with ensuring maximum employment in a context of price stability. And all of the guidance that we get from all the various economic data, in part, goes into the what will the cost of money be in the future conversation, which is really what we're talking about when we're discussing the Fed. All we're asking is, will money be relatively more expensive or relatively cheaper in the future? And how does that impact my decision as an investor or a trader today to say I'm going to deploy money by taking risk in markets, or I am not? And obviously, the more expensive the money is expected to be in the future, the less I am inclined to part with my cash and deploy money at risk. Because if it's going to be more expensive to get it back later, I might want to keep it. I might want to earn what will be a rising return on money going forward. I might not want to lose it because borrowing back might be an expensive sort of proposition. So the input into investing decisions, that is the cost of money, is critical. The input into the cost of money, first and foremost, is obviously Fed policy. And the input into Fed policy is jobs data because it is one half of what they're aiming at. We'll get the inflation piece next week with CPI numbers. But this right here is unmistakably a main event. And the reason the markets have been so reactive to even minor or seemingly minor numbers like 114K when just a few months 108K barely spooked anyone is we are now within striking distance of the first Fed rate cut of this cycle. And make no mistake about it, speculation about this rate cut cycle has been defining for stock markets and broader markets, but really stock markets in particular, for the better part of the past year. You can see it with the naked eye here. So consider where we've been in this rally that begins late October, early November. And the very first thing you notice is that the markets seem to have a sclerotic relationship with the Fed. And so it's tempting to say, there's no pattern here. But wait. So you consider where we start. And when we do, the markets expect about 78 basis points or 3 rate cuts with some slight optionality on a fourth to happen through 2024 and 2025. In the gray is the outlook from Fed funds futures for this year, as it is baked into the pricing there. The yellow is next year, 2025. The orange is the sum of the two, so the forecastable sort of Fed rate cut cycle window. As we start this rally, we're looking for 3 cuts. And we can see as the outlook grows more dovish, this is where stocks go up. So they are essentially cheering that the rate hike cycle has ended and that the Fed is now looking at some sort of a wait and see purgatory period before it cuts. But the focus now is, when are the cuts coming? And we can see that anticipation of the cuts is something that marks a major bottom in stocks, and they go up. We see here, as they do, the outlook is getting more dovish. So there seems to be an inverse relationship between what the Fed is thought to be doing and stocks. The more cuts, the higher stocks go. It changes once we get to about 2% worth of cuts for the cycle. That's at the start of this year. And we can see that from here until about the middle of April, the outlook for the Fed and stocks are moving in tandem. They invert this relationship and go up side by side until we get mid-April to a point basically equivalent to this one. 3 cuts, 76 basis points. And then they diverge again, where now stocks going up is consistent with a more dovish outlook until July, where they converge again. And now stocks go down as things get more dovish. So it's tempting to say, well, this is inconsistent, this is not a good indicator, but in reality, all this needs is context. And that comes From another thing that you might be tempted to dismiss because of inconsistency, economic data. And here we distill economic data into the Citi US Economic Surprise Index, which tracks data relative to forecasts. Index goes up when data is tending to beat forecasts. It goes down when data tends to undershoot forecasts. Above zero means there's a general tendency to beat. Below zero means there's a general tendency to miss. Take a look. This right here is October 2022, where data starts to sour relative to forecasts. That's a major inflection point. Fast forward into the second half of 2023, and here's another one. Notice what starts to occur here. Here's October 2023. U.S. economic data is starting to weaken significantly on approach to zero relative to expectations. So when the Fed right here says we're done hiking, we're going to see what's next, but we don't think we need to hike anymore, why does this move dovish? Well, because the data is saying that the bias on growth is weakening. It's beckoning stimulus. And the markets go, oh, good. While we have a weakening economy, the Fed is not going to sleep at the wheel. They're being responsive. They're saying rate hikes are over. They're going to cut. Good. Stocks go up. What changes this at the beginning of the year? Well, take a look. Data starts to actually improve. And through the first half of this year, we get a relatively rosy story on U.S. economic data. It begins to improve relative to forecasts. And so the markets say, well, we don't need as many rate cuts, so we can dial this down, but we don't need them for good reasons. We don't need them because growth is looking better. The economy is looking stronger. That's not a reason to sell stocks. Yes, cuts are coming, but they're maintenance cuts. Inflation expectations are falling. The Fed is having success. It's taken inflation down by this point from close to 10 to close to 3. And so obviously it's having the effect it was desiring. That means that if you don't cut nominal interest rates, real interest rates, which are nominal rates minus inflation, which is falling, gives you the real cost of money. If you don't cut nominal rates as inflation comes down, the real cost of money spikes. And then you really do hurt the economy. And that's all the Fed is going to do here, the markets think. They're just going to give us some maintenance. This is not anything to worry about. They just don't want to over-tighten. But the economy is doing fine. Let's dial back how many cuts we need. We get right back to 3 cuts here, and shock of shocks, mid-April, there is another turn in the data. It starts to deteriorate precipitously. What do we see then? Not only do markets start to get much more dovish, but since the Fed is being resistant to cutting rates at this point because the economy had been strong and inflation wasn't falling as fast as they wanted, the market says, you're missing that the economy is weakening by not cutting, which means that for all of your holding in 2024, you can see the gray bars here fairly steady, you're going to have to do a lot more easing in 2025 to catch up. And before we even get to July's and August's shenanigans, the markets are betting for 3 months going that the Fed is late. And that they're stalling here will mean more easing here. And so the outlook gets more and more dovish. And stocks go up because the markets figure, well, the Fed is going to have to really go big now. They're going to have to give a lot of stimulus. We get to the beginning of July, and the Fed begins to say, okay, now is the time. First, Jay Powell says it in testimony. Then we get it from the July 31st Fed policy meeting. Most recently, Powell reiterates it at the Jackson Hole Symposium. And so at this point, the markets go, wait, for 3 months, we've been saying that the Fed is behind the ball, and that's why we've baked all of this out. If the Fed is now saying now is go time, and the risks to unemployment being too high are now almost on par with inflation being too high, well, that means that perhaps they've spied something so adverse in the economic outlook that they're ready to move. And the markets start to speculate that maybe we're going to get a 50 basis point rate cut when the Fed finally makes the leap in September. We get some really weak economic data here, and so the markets jump to once again see a fully 2% rate cut cycle through the end of next year. The panic abates and the markets recover, but notably, they don't retake July's high. As a matter of fact, they stumble ahead of it. And the market never quite gets off this 2% shift that it got to from here. It never quite gets any more hawkish, signaling that investors are still worried that the Fed might be behind the ball. Which brings us here. We're a little bit favoring of a 25 basis point cut, looking at Fed funds probabilities currently. But it is mighty close to a 50-50 coin toss. At 41.59, there is still a very significant chance that the markets might see a 50 basis point cut. And this is where the interpretation of this jobs data becomes so important. Now, this right here would tell us that U.S. economic data since mid-July, as we were just looking at, has tended to underperform and increasingly disappoint relative to forecasts. That might be what we get here if this pattern continues. That may not be such a bad piece of news for markets in the sense that they look at this and say, well, it was about a coin toss before, but now that we got this weak data, we're going to get this 50 basis point cut. The Fed is going to catch up. They're going to help to ensure that they are not behind the ball. This will be good for markets. We also see, though, that this outcome is starting to kind of anchor relative to expectations, and so maybe there's less scope for a big surprise. Let's say a positive surprise occurs and the numbers beat. Well, that too might be relatively good news for markets. They might say, well, if we get better looking data, then we don't need a 50 basis point rate cut because the economy is doing okay. And as we can see, the relationship between cuts and markets, or the Fed outlook and markets, it can flip depending on where the economy is and what the context says. So if the data is good, the markets will say, well, we don't need a 50 basis point rate cut, and that's good news. Markets can go up. Where does that leave us? Well, it leaves us with what happens if we print relatively as expected. And that, for the markets, might be the worst outcome of all, because it leaves this ambiguity intact. As a matter of fact, we saw a very clear showing of this dynamic, incidentally, as expected, as ISM service data came out just earlier today. Notice, Here was the numbers. Expected was 51.1. We got a little bit faster growth in the service sector, but only just a hair, 51.5. The internals of the report were a little bit disparate. The price index, inflation, higher. New orders not really going anywhere, but employment, that other piece of the Fed mandate, stalling in what is the biggest sector for U.S. hiring. 80% of U.S. jobs are in services. That, of course, echoed a similar thing with the manufacturing numbers on Monday. They, too, were very close to expectations. Here, they, too, had some conflicting Fed-related guidance. We can see here employment moving generally lower, shrinking at a slightly lower speed, but still under that 50 line, so still shrinking. New orders down, but inflation up. Again, ambiguity. What do the markets do? They briefly pop, then sink. Because numbers in line at status quo and therefore offering no insight on which one of these options is right are generally disappointing for markets seemingly here. So if we end up with jobs data that's not too far off a 160,000 rise in non-farm payrolls and a jobless rate of 4.2%, the markets will be left no wiser about where the Fed is going and stuck waiting for the next bit of event risk, CPI next week. That might well give us a bout of de-risking, weakness in stocks, strengthen the US dollar, and a lingering concern that the Fed is behind the ball, which might weigh on cyclical commodities like crude oil and might see the long end of the yield curve come down just as the front end comes up, giving us support for long-dated bonds but hurting the ones at the front end. And that is macro money for today. As ever, we are here Thursday or Monday through Thursday, I should say, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things go from there. I'm back on with Chris for Futures Power Hour tomorrow, on with Victor and Tom for First Call on Sundays, back with Victor for the Price of Truth on Wednesdays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back next week. Happy trading.